Hey, what's going on, guys? This is Greg with Ideal Trading Ideas, and today we're going to be talking about American Airlines. More specifically, we're going to be talking about how to do a covered call option trade with American Airlines. So recently, I had a comment on the page asking about how to do covered calls, and obviously I put up videos all the time about covered calls and the different stocks that we go over. So video is not going to be any different. I'm going to show you how to do that covered call with American Airlines, right? So we're going to run through the stock really quick. As you can see, this is the daily chart, and as of last Friday, we're up positive 11 cents or positive 0.53%, right? After hours, down 26 cents or negative 1.24%. The weekly chart says that we're up 28 cents or positive 1.37%. The monthly chart says that we're up 20 cents or positive 0.97%. The 3-month chart says that we're down 64 cents or negative 2.99%. The 1-year chart says that we're up $7.90 or positive 61.43%. And the 5-year chart says that we're down $13.46 or negative 39.33%. Okay, so in order to do a covered call or to do this covered call option strategy, you need to buy 100 shares of stock. Now, I know people would say, oh my God, 100 shares of stock, I'm going to have to pay out a significant amount of money. Now, there is another way to get around buying those 100 shares, and that would be a PMCC or a poor man's covered call, just the nicknames like a diagonal spread. But we're not going to be talking about that right now. We're going to specifically talk about covered calls, right? So you'd have to buy 100 shares. So if we pull the calculator up right now, and make sure we clear real good, we're going to say current price is $20.76, right? So you would put in $20.76 times the 100 shares, and you would spend $2,076, right? So to buy 100 shares of American Airlines right now, you have to spend $2,076. So let's say you went ahead and bought the shares and spent the $20.76. Now you own 100 shares of American Airlines. What do you do next? Well, the next thing you want to do is go over here to trade AAL options, click on it, and you come up with this screen right here. This screen is called an option chain. It's going to be different on Robinhood than it is from Fidelity or TD Ameritrade or so on and so forth for E-Trade, right? They just set everything up a little different. So what you have is AAL buy call. So you have buy, sell, call, put, and then you have an expiring date, right? So the expiring date is going to be for all these different contracts, and August 13th is this Friday, right? So it's going to be expiring this Friday. So you bought the shares for $20.76, and what you're going to want to do is make sure that whatever contract you decide to pick is above the $20.76 mark, right? So you have strike price, you have break even, to break even, percentage change, and price, right? So the strike price is going to be the price that you are willing to sell at. So this $21 strike price is where what you're saying you're willing to sell this at. The break even right here, $21.47, is the strike price and the premium paid to you or the premium paid out, depending on what you pick, combined. So in this case, $21 plus 47 cents, the break even is going to be $21.47, right? To break even is going to be the positive amount of percentages before you break even. So positive 3.42%, and then the percentage change is negative 6%. And then they show you the change by 3 cents and then the price, right? So basically last Thursday or last Friday, the price, which says 47 cents, was actually 50 cents. So it went down by 3 cents, right? And they're showing you the percentage change. So how do we do this cover call? The first thing you want to do is change that buy to sell. So now we have sell. Make sure you have call highlighted as well. We're going to keep the August 13th expiration date. So basically what we're saying is, for those of you who want to go ahead and make some income off of this, but want to also possibly sell your shares, you would just go ahead and pick the one that's closest to the actual share price. They will call that goodness gracious, I got a brain fart. So basically you have a at the money trade, right? So this would be at the money, $20.76 if you could buy it at $20.76. So this is basically near the money. $21 would be near the money. So anyway, you would pick this $21 trade, and they would pay you 47 cents per share, right? Which is 47 cents times 100 shares, which is going to be $47 up front, right? So once you purchase these shares, you would remember you have a break even of 21.47. So you would need to make sure that anytime you're doing, you have a break even of 21.47, but anytime you're doing your shares, remember you bought at 20.76, you need to make sure that you're picking a strike price that's above that 20.76. So $21 strike price is a perfect strike price to pick, picking up $47 for that week. They're gonna give you that money up front, right? $47 up front. And basically what happens is, if the price goes up from 20.76 to $21 or above, it's gonna sell off your 100 shares, right? So let's do the math. $21 times 100 shares is gonna be $2,100, right? If we pull the calculator up, that's $2,076 what you spent minus 2,100 equals $24. So you're gonna make $24 just off the sale of this going from $20.76 up to $21. Then you're gonna add in the $47 that they already paid you, right? So if we do positive 47, that may come out right, may not. So 47 plus 24 plus 24 is $71. So off this particular deal, if it sells at 21 by this Friday, August 13th, we'll collect a total of $71. Now, if it doesn't sell at $21 by this Friday, what would happen is you would keep your 100 shares that you purchased for $20.76. You would keep the $47 that you were paid up front for saying you're willing to sell at 21, right? And then you would move on to the next week or go even further. You can go to August 27th or even further in time to collect even more money the following week or whatever, right? So as it expires on August 13th, I would just move on to August 20th or the week of August 20th, which is next Friday. And let's say the price was still in the $20 range, right? Obviously this is going to change, but right now it's saying $69. So we may decide that, hey, we still want to go with this $29 strike. And let's say they're still offering $69. So they're going to offer $69 up front. And we're gonna do the trade all over again. What happens if it doesn't make the $21 again? Well, we still keep the $69 and we still keep our 100 shares. So this is how a covered call would continue to work, right? You still own your shares and they're paying you a premium up front. If it does hit that $21 strike price and is there by the expiring date, then hey, your 100 shares will be sold off. And you would just keep the premiums that they paid to you plus the money difference in between where you bought and where you sold at. That's how that works, right? So in that particular case, if you went 2 weeks out and we had already said they paid you 47 1 week, and then if you did it for a second week, they paid you 69, pull the calculator out real quick, 69 plus 47. In the 2 weeks time frame, you would have made $116. Now, in terms of what you spent out, you're probably saying, man, I'm not making a whole lot of money from this, but this is premium income. This is passive income that's going to come in over time, right? So every week, you can even do it monthly to kind of pull a certain amount of money, right? So the goal of doing these covered calls is really to average the price that you spent down over time, right? Because you own these shares. So you're waiting for the price to go up, and at the same time, you're picking up these premiums over time, right? So what happens if you still own the shares and you've picked up an extra $500, you would just look at what you spent, which was $20.76, and let's say you had already made $500 off of doing the covered calls, then you would just minus out the $500, and now you actually have averaged yourself down to $15.76, which means if the price is still $20.76, you could sell off your shares at $20.76 and still pick up an extra $500 plus dollars, right? Or $500 actually. So you would actually come out the deal ahead. You got what I'm saying? You would actually come out the deal ahead, right? You would make some money off this particular deal, right? So this is basically how you would do the cover calls, and I'm gonna go right through it real quick just to show you. So you've already purchased the shares. You decide to pick the $21 strike price. You would click on the positive sign right here. It says short call, $21 call, expiring August 13th, negative 47 times. It says total credit of 47 cents. As we scroll down, it says expected profit and loss. AAL price right now is $20.80. It's went up over time. Max profit is $47. That's what they're going to pay you upfront. Max loss says unlimited, right? And then it says break even $21.47. So what does it mean by saying max loss is unlimited? Anything over the $21.47 mark is going to start costing you money. But in actuality, it's not costing you anything. This is the money that you left on the table if the price, because you decide to sell the price at $21, right? You start to sell your stocks at $21. So this is all the money you left on the table if it went past $21. Hopefully you understand that. So break even is $21.47. So at this white dot right here, $21.47, this is where the $47 mark starts becoming a little blurry, right? That $47 they paid you up front obviously starts turning negative. You don't have to pay any money out or anything like that because you've already sold your shares at $21, right? Gotcha. So what we're going to do is scroll up, click on continue. And as you see, it says short call, it says contracts. One contract equals 100 shares, right? So the limit price right now is 45 cents to 48 cents. The in between is 47 cents. The minimum credit paid to you will be $47, right? Once you click on review, it's going to go through all of this and you're going to have your shares. Right now, the market is not open. Obviously, it's 7:15 in the morning and it's August 9th, 2021, right? So when the market does become live, these prices may change. It may go up, it may go down. We just have to wait and stay tuned. But this is how you would perform your cover call. Hopefully I've explained this to you guys. And if you have any questions, concerns, comments, hey, please drop it inside the comment box. I really do appreciate all the love and support for the channel. Please like, subscribe, comment. And if you want me to go over anything else, any particular stock to do a stock review on, hey, just drop me a comment and let me know. Once again, you guys have a great day. Enjoy yourselves. Bye.